Look, I did a piece a couple of weeks ago, a blog post that I put onto the Evidente website, in which basically what I've done is drawn on some of the research that's been done by the Fed and the IMF, which basically shows that the neutral rate of interest is kind of close to zero globally. And against that backdrop, firms or stocks that offer earnings certainty will continue to do reasonably well. So the focus of that particular piece was some of the listed infrastructure stocks, which are, across various measures and metrics, they're actually trading reasonably expensive, including Transurban Sydney Airport and APA, the gas line operator. Unfortunately, it's a very narrow list from which to choose from to capitalise on this thematic of earnings certainty. So what I've done is I've developed a reasonably kind of simple systematic model which kind of looks at a number of different market-related measures of earnings certainty, such as the stock's beta, its return volatility, its dispersion of analysts' forecasts, the stability of EPS, and also the number of years in which it's been listed. And most of those are reasonably self-explanatory. The vintage or the amount of years that a firm's been listed probably requires a bit more explanation. It's this kind of idea that firms that have only been listed for a short period of time are more likely to be associated with a bit more uncertainty. Not so much because of the industry that they operate in, more just because investors will take time to understand the firm's track record as it unfolds, and will also take time to understand the skill set of management as well. And interestingly, we've actually kind of seen some of those IPOs from last year that were reasonably kind of well bid on listing have actually kind of performed reasonably poorly since then, such as Healthscope, Spotless and a couple of others, obviously kind of Dick Smith as well. So I think kind of investors need to be careful about bidding up too aggressively these stocks that have been listed for a short period of time. So with those 5 factors, including the vintage factor, I kind of put them together and develop a composite score for earnings certainty. And some of the stocks that actually kind of come up as the strongest rated amongst the big cap stocks are Amcor, ASX, Brambles, Ramsay Health Care and Coca-Cola. So kind of some of the more familiar names. And what's interesting is the model actually doesn't, I think what's interesting about this model is what it doesn't contain than what it actually does contain. There's no reference to dividends or profitability or valuation metrics. Really, they are just market measures that I spoke about before, including the vintage. And yet it kind of seems to produce a list of stocks that most people are comfortable in terms of dividend sustainability. Some of the poorly ranked stocks are Myer Holdings, Broadspectrum, Spotless, Gemworth and Seven Group Holdings. I've done a back test of the model, so where I've rebalanced on an annual basis going back to 2011, the performance has been very strong, so it hasn't just been a recent phenomenon. And even importantly, excluding the resources names, because most of the resource stocks actually rank pretty poorly on this model of earnings certainty, even excluding the resource stocks. The model's kind of developed got a strong track record of producing alpha over the last 4 to 5 years. I've also developed a similar model for the small cap stocks. And what's actually quite concerning, if not alarming, is the prominence of a large number of small cap REITs that kind of feature prominently as earnings certainty stocks. So stocks such as the top ranked stocks, of the top 10 ranked stocks in terms of earnings certainty, 6 are actually REITs in the small cap space. Just some of them: BWP Trust, Growthpoint Properties, Generation Healthcare REIT, Charter Hall Retail REIT, Folkestone and Astro Japan Property Group. So it's important to kind of also draw attention to the fact that these systematic ranking models that I've developed for earnings certainty and other factors, I don't see them as the final point of the analysis. They kind of, I think of them as a starting point. There's no top-down analysis in constructing these models. So therefore, it's important to actually have a top-down overlay once you've actually developed the screening process. So for mine, I think it's quite alarming that there might be potentially too much complacency in that small cap REIT space at the moment, to the extent that a large number of these stocks feature prominently amongst the top ranked stocks for earnings certainty.